Hello, this is Charting Man Dan of TheChartGuys, where we teach the little guy and girl how to utilize charts to manage their own trades and investments. What do I mean by the little guy and girl? Well, we just had two directives signed halting the implementation of a rule that requires financial advisors to act in the best interests of their client. Let that sink in a little bit. The big wigs on Wall Street can play with your retirement and hard-earned money without your best interests at heart. We currently have hundreds of members taking charge of their financial future, and we would love for you to come check out a free week with no credit card required to see if our services would be beneficial on your path to financial independence as well. What we offer, we have a separate course of over 5 hours in length on when to enter and exit positions. And in terms of what we do daily, we have nightly videos, key levels updated each morning before the bell, 2.5 hours of live daily webcam coverage in the morning and in the afternoon, and over 7 hours of educational videos. All of these links can be found in the description of this video. Come check us out. Thanks for watching. Let's get on to the technical analysis. Hello everyone, looking at the market rundown, SPY, IWM QQQ. What a wild week, what a wild end to the week. All this back and forth with the healthcare bill, blah, 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 all the fundamentals. And so what we have is the market pretty much, it's been factoring in a Trump administration that is looking to deregulate and revision the tax code and all that. And so if they can't pass the healthcare bill, then the market's kind of saying, well, maybe all the other things that we're pricing in at this point for looking into the future aren't going to end up playing out. So that is what is causing all this volatility, and there's spikes back and forth, and it's really essential to have stop losses in place if trying to day trade or if trying to do any trade, because it can run away very quickly from us. So looking at SPY, we do still have the potential for a bear flag, and as long as we are unable to get over the exponential daily resistances, the 4 and the 8 period here, that will remain the case, and we've rejected from those levels 2 days in a row now. We did get lower lows today. The low of the dump originally was down at 233.05, and we broke that to 232.96, only by 9 cents, not very significant, and the bulls did buy some of that dip towards the end of the day. So we are still holding the lower Bollinger Band support. That's descending. And again, as long as these exponential moving averages are resistance, the bears will be in control, in my opinion. So the weekly time frame, we closed right at this 8-period weekly, the exponential moving average, 233.68. We closed just above it. So we are still holding this level. This is the most bearish week that we have seen since the election. So that's noteworthy. And what else should stand out when looking at this chart? It's the most volume we've seen in about 3.5 months, and it favors the bears. So that is definitely noteworthy. If we see further downside next week, we're going to be closing in on a bearish TCG cross of this 4-period exponential moving average over the 8-period to the downside, and we'll be closing in on a bearish TCG cross, or I should say a bearish MACD cross, which is also very close to following through. So we have to be aware of these things. And now on the daily time frame, now that we have our lower high and our lower low, we are now going to look for that to continue. So as soon as we hit that lower low below 234.72, that shifted our mindset from the bulls being completely in control to the bears now having the momentum. So if we do break 232.96, the low that we saw this week, I'm looking down at 232.84, the low of this consolidation day that we had there. And then we start looking at these gaps because we had such a strong move in February. I'm looking at a gap at 230. Actually, let's look here. That gap is at 230.77. Looks like there's another gap down here at 228.40. And then there's another gap down here at 227.11. So there's gaps all over the place to be keeping an eye on as targets. The 50-day moving average support would come next after that, 232.84. And that level is going to be in the low 232s. IWM, still seeing some nice recovery and still acting a little bit stronger than the S&P 500. But again, that is because this dump was a lot harsher on Tuesday and Wednesday. Wednesday saw a lot further follow through to the downside than the S&P 500 saw. So making up for it right now, rejecting from the exponential moving average resistances as well. The 100-day moving average support held 2 tests. That's going to be in the upper 133 range and a level to be watching. And the weekly time frame here on IWM is not showing up, so I have to adjust to the weekly real quick. But it's a battle for that middle Bollinger Band this week, and we lost it. 135.02. We have held that level since the election. So the fact that we have lost that level now does make that significant. And again, look what stands out, the volume. Highest volume that we have seen in 4 months. So to maintain the higher low pattern, the key support was 130. Let's see here. It was 132.74. and 132.79, and we dropped down to 132.40, but the bulls did buy that dip with a little bit of a lower wick. But now that we've lost this middle Bollinger Band, if we lose that level more convincingly and see it close below 132.74, we lose the weekly higher low pattern, which has been intact for a very long time. So that would be looking to shift the trend to favor the bears there as well. QQQ has been the strongest due to the tech sector still holding up and keeping QQQ in the lead. It too is still rejecting from the middle Bollinger Band and the exponential moving averages. We closed right at those levels and just below them. So this too is still a potential bear flag as long as those exponential moving averages are resistant. If the bulls can get over those levels early next week, we will know they have some strength because we have seen some higher lows the past couple of days. We had a higher low on Thursday, and now again, well, actually here on Friday, it was a double bottom, 130.14 and 130.13. So that's a key support into next week. Lose those levels, and we're looking down at 129.68. So losing the middle Bollinger Band for the first time in 2017 was obviously a red flag for the bulls in the short term. And on the weekly time frame, we have our bearish reversal candlestick. And need to zoom in here, but this is the first bearish reversal candlestick that we have seen in quite some time on the weekly. Look how many green weeks we had in a row. We had 6 green weeks in a row, and we had 10 of 11 green weeks in a row. So this is the most bearish candlestick we have seen in 2017. It's a bearish reversal candlestick with high volume, so you can see the correlation at this point, where all of these markets are seeing a high volume bearish candlestick this week. If we confirm it with another red week next week, it will be the first bearish reversal candlestick confirmed since the election. That's a long time and a lot of uptrend. So we're watching very close. We're being very cautious bullish because the bears do have some momentum here heading into next week. So we'll continue checking in as always. Again, lots of volatility, and can always see when the interest picks up just by the views of these videos. And the views in these market rundown videos are up about 20-25% the past couple of days. So people are certainly paying attention to this volatility and wondering where we are headed next. And next week, weekly candlesticks, tons of individual names have bearish reversal candlesticks, and we're watching to see if we're going to confirm them. Thanks for tuning in. Have a great rest of your weekend, and we will see you on Monday.